Law firm owners, are you tired of handing your hard-earned income to the IRS? What if I told you there is a legal tax way to cut your tax bill significantly and keep more money in your firm? Stick around because today we're breaking down the S Corp tax strategy that law firm owners are using to slash their tax bills. Many firms leave tens of thousands of dollars on the table every year simply because of how they're structured. While many law firms start as sole proprietorships, general partnerships, or LLCs, these structures can lead to excessive self-employment tax burdens as profits increase. So if your law firm is making $250,000 or more in profit, restructuring as an S Corp can help you dramatically reduce self-employment taxes and increase take-home pay. So how much are you losing to self-employment tax? As a sole proprietor or LLC owner, every dollar you make is subject to self-employment tax, meaning a significant portion of your income goes straight to the IRS before you even pay your federal and state taxes. That's Social Security and Medicare. Here's what that looks like with $1 million in profit. The first $168,000 is taxed at 15.3%. The remaining $831,000 is taxed at 2.9%. As a total, your self-employment tax is nearly $50,000. These taxes are in addition to federal and state income tax, which can be as high as 37% at the highest federal bracket. So this is how an S Corp saves law firms money. So unlike sole proprietorships and LLCs, S Corps allow owners to split income between a reasonable salary, the portion subject to payroll taxes, and distributions, the portion not subject to self-employment taxes. Using our example from earlier, let's assume the law firm earns $1 million in profit and elects S Corp status. Per IRS guidelines, you need a reasonable salary, so let's assume it's $200,000. The first $168,000 is taxed at 15.3%, and the remaining $31,000 is taxed at 2.9%, which leaves a total payroll tax of $26,000. The distributions on the remaining $800,000, it's not subject to self-employment tax, which leads to significant tax savings. So the total estimated savings are $23,000. By making the S Corp election, the owner reduces payroll tax liability compared to a sole proprietor, which keeps more money in the firm. For more tax savings, join our school group for law firm owners, where we are discussing advanced tax saving strategies tailored just for law firms. The link is in the description below. When should law firm owners switch to an S Corp? So the benefits of an S Corp increase as your profitability grows. You should consider making the switch if your law firm has $250,000 plus in net profit and expects to continue to grow. You're already paying substantial self-employment tax and want to legally reduce that burden, or you want to increase tax efficiency while staying compliant with IRS regulations, or you're looking for a structure that allows more financial flexibility, such as reinvesting in your firm, hiring new staff, or expanding operations. Also, if you plan to build long-term wealth by keeping more of your earnings rather than overpaying in taxes each year, you should consider whether this will work for you. Here are some important considerations to think about before choosing an S Corp. So, switching to an S Corp is a game changer for many law firms, but there are key factors to consider to make sure it works for you. Understanding these considerations will help you avoid costly mistakes and maximize your tax savings. The S Corp election must be filed using the IRS Form 2553 within 2 months and 15 days of the beginning of the tax year for full year benefits. If you miss the deadline, the election may only take effect for the next tax year, which will delay the tax savings. So Consider mid-year conversions very carefully, as switching entity types mid-year can create tax complexities. The IRS has a rule around reasonable salary. The IRS requires S Corp owners to take a reasonable salary before taking distributions, and if you pay too little in the salary, it could trigger an audit. Benchmarking your salary levels within your legal practice area can make sure that you're compliant there. Although you know that you can only share ownership with other lawyers, these lawyers must also be U.S. citizens or residents in order to take advantage of an S Corp. For more tax savings, join our school group for law firm owners where we're discussing advanced tax saving strategies tailored just for law firm owners. The link is in the description below. And if your law firm is earning $250,000 or more, electing S Corp status could significantly reduce your tax liability. But to explore your options and structure your firm for optimal tax savings, you can also book a call with us, which is also in the description. There's a link there. All right, take care.